Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Optimism spreading. European stocks open higher as traders gauge the health of China's economy. But the IMF is warning 1/3 of the world will fall into recession this year. COVID struggle. Xi Jinping warns tough challenges remain in China's battle against the virus. But signs emerge infections may have peaked in some major cities. Plus, coming up short. Tesla's quarterly deliverances miss expectations despite offering rare incentives in the U.S. and China. Well, it's been an hour of cash equity trading in Europe. Yes, European markets are higher. Equities are higher, as they are in the S&P. Yesterday, Europe ended the day with a nearly 1% gain. The U.S. fell, so maybe a little bit of catch-up. Of course, still thin trading, at least yesterday when the U.K. markets were closed, so perhaps not too much to read into that. But one of the big reversals this morning has been the yen. It started out with really strong gains, up nearly 1% versus the dollar. That was its strongest since June. It started to come back in just about 0%, basically unchanged. It was these bets that the BOJ would tighten policy further. Is that coming off, or are we just getting a difference of opinion as we get through the European Open? Gold, this one continues to be a winner this morning. It had a really tough 2022 with a stronger dollar. If that's coming back in, and we have all these warnings of a recession from IMF's Georgieva to Michael Burry, perhaps this is the year for gold. And finally, your 10-year yield, that's getting a bid as well. 11 basis points lower is where we stand. That also follows on from a European bond rally yesterday. Now, European equities, second day of gains. It's on track for its biggest two-day gain since November of last year. The real standout here is the UK, but that's simply because it has to play catch-up. We were closed yesterday for a bank holiday. It is back online, so that is one of the best performing regions, but all sectors and basically all regions in the green this morning. Of course, one fear that continues to preside over this market is China and the impulse from there. So let's get into it. Chinese President Xi Jinping has warned the fight against COVID will be tough in his first comment since Beijing's pivot away from its zero COVID policy. All of this comes after data released over the weekend showing China's economy ending the year in a slump with a slowdown in manufacturing worsening. However, there are signs of the virus peaking in some major cities, according to travel data. Joining us now is Alan Wan, Bloomberg senior editor in Shanghai. So, Alan, let's start with that speech from Xi Jinping. What were the main takeaways there?
Well, you know, the government hasn't really said a whole lot ever since it exited COVID zero about a month ago. So we're going to hone in on anything he had to say about COVID. And his message was mostly empathetic. For example, he described the policy change as a way to adapt to a virus that keeps evolving, a virus that, while it's super transmissible, fatalities are actually lower, are actually quite low. And then he also he talked about how, and it was a really more of a rare acknowledgement of the difficulties that people here in China are facing after 3 years of pandemic restrictions. And this is the most interesting part of it, I thought, was that, you know, even though he didn't directly talk about the protests, he did say that, quote, it's only natural for people, you know, in a country of 1.4 billion people to have differences of opinion and views. And basically, the message was a lot more empathetic than I had expected. And I was looking at last year's, same time last year's address, and it was very brief. And he talked about the rejuvenation of Chinese people, Hong Kong, Taiwan, and the Olympics coming up, but no direct mention of the challenges facing China in terms of COVID.
At the same time, in terms of those economic challenges, the Caixin PMI data over the weekend showed a major manufacturing contraction. Services were really grim as well. When do we get that rebound? Do we get the positive impulse from a populace which is igniting demand?
Yeah, I mean, that's a great question. I mean, the Caixin PMI data was pretty bad, showing that manufacturing services keep on declining. I mean, this is reaffirming what we saw over the weekend. And then we also had the China Beige Book, suggesting that the economy actually contracted in the fourth quarter, and it sees the GDP growing 2% last year. I mean, that said, that's all the bad news. But the good news is that along with that Caixin data, where they survey all these businesses, a lot of these businesses are actually a lot more optimistic about the future. there was a in terms of confidence on the 12-month outlook, it reached a 10-month high. There was a gauge of future output jumping to the highest level since February 2022, which Bloomberg Intelligence says is actually showing that how the end of COVID zero is starting to boost business sentiment. And then you got Citigroup economists saying that a PMI probably hit a low point in December, and we're going to recover from here on out. And what does this mean for the overall economy? A lot of Bloomberg economists, economists served by Bloomberg, forecast the economy growing at 4.8% this year, which is it'll be a lot better than the 3% which is estimated for last year.
Yeah, certainly better, but maybe just short of China's goal there. Alan, thank you very much. Alan Wong from Shanghai. Joining the program now is Michaelides, G10 fixed income analyst at Carmignac Gestion. Michael, thank you so much for joining this morning. We're just talking to Alan Wong about China, about the fact that data has been bad for December, but looking forward in terms of the demand finally coming into the picture, how are you looking at the swing factor of Chinese demand as it impacts the G10 space?
So first of all, thanks for having me. I think the earlier than expected reopening of China kind of just adds to the global demand pressures. Like, we know that in 2023, we're going to be in a situation where the world economy is slowing. As you discussed previously, we will have recession in a number of countries. And I think that is kind of already expected. The question is not whether or not we have a slowdown, but how quick that slowdown is, and whether China coming on board sooner then delays even further the point of recession in the US and makes it even less deep, the potential recession we have in Europe. So that's the way I think we're thinking of the impact of the Chinese reopening on G10 and G10 interest rates and other fixed income markets.
Well, Michael, you mentioned this idea that a recession is widely expected. There's someone else who expects it, your namesake, another Michael Burry, though. He has a tweet in terms of his 2023 view, and I want to read it to you. He says, inflation peaked, but it is not the last peak of this cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the U.S. in recession by any definition. But this is the key here, Michael. He says the Fed will cut and the government will stimulate, and we will have another inflation spike. What do you make of that, this idea that the recession will be bad enough, the Fed blinks, and that in itself causes another bout of inflation?
I think we're several steps ahead looking at it that way around. I mean, the way that we kind of see the world is that the delay of the oncoming recession means that actually in the short term, it could look like with headline inflation coming down and the world economy getting over the initial impact of inflation, that short term things will look quite good. The Fed's strategy change will be intact. And so coming into the third quarter, things could look very fine. The problem is that underlying inflation will remain strong. So rather than us worrying about negative prints, the kind of core services that the Fed has been highlighting, that may remain quite a lot stickier. So while in the short term, the markets were probably quite pleased with the lower volatility, in the end, what we're concerned about is that you need a much harder landing to kind of purge the system from inflation, rather than the idea that we could have negative inflation prints as soon as this year.
What do you do with duration then, Michael?
So I think duration will be quite a nuanced story. I think in the US, the most likely scenario is that the market is too keen to see Fed cuts. There are probably too many Fed cuts priced in light of the new strategy of the Federal Reserve, which is not to go as quickly, not to go as high, not necessarily to go as high, but to keep interest rates much higher. So what you could end up happening is that real rates do not fall as quickly as they do in historical cycles. And for that reason, the market's playbook of recession equals aggressive Fed cuts equals you can be very long duration at an early stage in the cycle may not be the right way of thinking of it. So flatteners may be the way of thinking of it in the US, and being nimble around how quickly the inflation data comes off. By contrast, in Europe and the UK, we think the story is a bit different.
I was about to say, Michael, you were very careful to say that this is the story in the U.S. So then what is the story in Europe so far to start the year? And I know liquidity has been thin, so perhaps we can't read too much into it, but it has been a bond rally for all of Europe, more or less.
That's true. It's a one-day move. We've also had a very big sell-off in December. I think one way of thinking of the difference between duration in the US and Europe is the relative patience of the different central banks. So while both of the central banks think you will be, the ECB and the Fed, think you will be near 2% on the sort of 2 or 3 year horizon, in the case of the US, they are waiting to see the impact of the slowdown, waiting to see how quickly and the depth of the fall of inflation and what happens to the labor market. And so they may be more willing to be patient to get inflation down. I think the revisions to the data and the communication of the ECB, even after a very big sell-off after the December meeting, indicate that the ECB is not in the same position. So they want to get inflation to 2% as quickly as possible. So the speed of rate hikes and the further increase potentially in the terminal rate in Europe is potentially more likely than in the US in a structural sense. So that's why we do see differences in the duration outlook.
Yeah, just over the past few days, we heard from both Nagel and Madame Lagarde saying that they have more work to do to make sure that inflation expectations don't get entrenched. Michael, really wonderful to get your thoughts this morning. What a great way to kick off the new year. Michael Michaelides, G10 fixed income analyst at Carmignac Gestion. Now, coming up, Tesla falls in pre-market. It's down 4% at the moment after deliveries for the last quarter miss estimates. We'll have more on the electric car maker shortly. This is Bloomberg. Tesla delivered fewer vehicles than analysts expected last quarter, despite taking an unusual step of offering hefty incentives in two of its biggest markets. Joining us now to discuss is global business reporter Hee-Jin Kim. Hee-Jin, tell us more about these delivery numbers, how they disappointed what was expected.
Sure. So as you mentioned, the Tesla delivered about 405,000 vehicles in the last 3 months, and that was below the analyst estimates, which was about 420,000. And the company even missed its own sales target, which was about 50% increase in deliveries last year, but it made about 40%. So this was also actually increasing concerns for the Tesla, which is the world's biggest EV brand. Everyone is checking what's going on in Tesla. There's a concern that Tesla seems to be struggling, especially in China, where there are a lot of local brands such as BYD, and we also have the fears of a recession and inflation, rising interest rates, and that's so the recent earnings from the Tesla all the adding to those kind of worries.
And already pre-market shares are down about 3.5%, just adding on to the tough year last year. So what is this latest figure? What does it mean for investors and Tesla suppliers?
Sure. So honestly, investors are actually upset about the Elon Musk's buying of the Twitter. They say, a lot of fund managers and analysts say that they still don't understand why Elon Musk is paying so much attention to the, Twitter. They say, Elon Musk should be working hard at the EV factory rather than, analyzing the Twitter's data. And also, there's a concern about, from the, Tesla suppliers as well, in Asia, such as like battery makers, lithium miners. They are all, concerned about what's going on at Tesla, because, those kind of sales data from the not just the EV maker but the automobile, maker actually signals that the global economy is slowing down.
Hee-Jin, thank you very much for the update. That's Hee-Jin Kim, our global business reporter in Seoul. Coming up on the program, rail pain. UK workers are set to walk off the job for much of this week, adding to the government's troubles. Well, more on strikes next. This is Bloomberg.
If I had to choose one market to invest in, it would be the UK over the next year. The UK economy this year in 2022 has probably done better than almost all of its peers.
In the UK, we have got some phenomenal talent.
We have phenomenal talent here. We really do.
I regard the outlook for the UK as being better than most commentators would suggest for next year.
What this year has shown us is that the business community loves stability.
The cost of doing Brexit is now baked into everybody's thought process.
We will get through and settle inflation down. It will take some time, but all of that is within our control.
We're going to do better than the Eurozone by quite a margin, and possibly better than the US.
Some prominent investors and executives speaking to me on the UK and what opportunities and hazards they see in 2023. Now, speaking of hazards in the UK, there's more pain ahead as rail workers plan to walk off the job for much of this week. It all piles up trouble for Prime Minister Rishi Sunak's government. For more on this, let's bring in Bloomberg's Lizzie Burden. So, Lizzie, how is the government handling these strikes?
Well, it's holding its line at the moment. We heard from the Defence Secretary Ben Wallace. He says that the government isn't going to be held to ransom by the unions as it was in the 1970s. But really, no matter how much Rishi Sunak wants to do his Margaret Thatcher impression, if the strikes continue, if they broaden across the sectors, it's going to look like the end of the 1970s when the UK was paralysed by strikes, which brought Margaret Thatcher to power. Now, we're starting the year with these 5 days of rail strikes. That's holding back retailers from making the most of the January sales. It means more people are going to work from home. And that, as a theme for 2023, is something that the Chancellor, Jeremy Hunt, I understand, is very worried about because it holds back growth. But really, the overriding concern among Treasury ministers is that if they capitulate to union demands now, there'll only be more in the pipeline as inflation remains high through 2023.
So this is clearly one big concern for the government this year. What else is in Rishi Sunak's in tray?
Well, economically, it's the same macro themes as last year, the same as elsewhere, inflation and recession. The question is, can the Bank of England tame inflation without stoking the recession it says the UK is already in? And in his New Year's message, Rishi Sunak said that, yes, 2022 was difficult, 2023 is also going to be difficult. And I find the executives you interviewed extremely optimistic there, in contrast to a survey of economists that was in the FT, 101 of them who said that the UK's recession is going to be longer and worse than any other G7 country. The words they were using were bleak, miserable, grim, so very different indeed. And that's going to shape the Tories' agenda for 2023 because they're very behind in the polls. One poll said that they were 26 points behind Labour. They've got to call an election by January 2025. And so in the meantime, they're going to have to show that they have the talent, the ideas, the unity to get another term in the bag. And so two key dates will be the March 15th budget. They need to show that they're serious about growth, that the dullness dividend has paid off and they're now willing to take some risks and grow the economy, the one thing that everyone agrees Liz Truss got right. And then the other date is in April, the 25th anniversary of the Good Friday Agreement. Can they get a compromise on Brexit to deliver that stability that Poppy Gustafsson from Dark Trace told you she says businesses desperately crave?
So just an easy breezy year ahead. Nothing big on the agenda.
It's Rishi Sunak. Let's give him a chance.
Lizzie, thank you so much. As always, Bloomberg's Lizzie Burden there. Now, we're going to be covering all things all UK every week on Thursday. It'll be at 9 a.m. UK time in our half-hour special, so be sure to tune into that in the next few days. Now let's get to our Bloomberg First Word News. With that is Laura Wright. Good morning, Laura.
Good morning, Danny. President Xi Jinping has spoken out about China's COVID pivot, saying tough challenges remain in the fight against the virus. In a New Year's address over the weekend, Xi said the country is in a new phase of COVID control and has adapted after following a science-based and targeted approach. IMF Managing Director Kristalina Georgieva says a third of the global economy will face recession this year. In an interview with CBS, Georgieva said 2023 will be a tougher year than the one we leave behind. She says the US, the EU and China are simultaneously slowing down, with the outlook for emerging markets even worse. Moscow's defense ministry says a Ukrainian strike on a Russian military facility in the occupied east has killed 63 troops stationed there. Ukraine, meanwhile, has warned that Russia may launch more attacks over the Orthodox Christmas holiday later this week. China's economy ended the year in a major slump as business and consumer spending plunged in December as COVID infections spiked. Official data showed the decline in manufacturing worsened last month, while activity in the services sector plunged the most since February 2020. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny.
Laura, thanks so much. Laura right here in London. Now, equities continue their climb in Europe. It's a second day of gains. U.S. futures also pushing highs for the morning. They're up 1.1%. Now, the yen is coming back a bit. It was unchanged. It did start this morning up 1%. It goes to unchanged. Now it's higher or stronger versus the dollar by about 1/3. It is traders betting that the BOJ is indeed going to have to tighten. Also, those recession concerns driving investors to havens, not just gold, but treasuries as well. Coming up, Turkish inflation decelerates at its steepest pace in more than a quarter of a century. We'll have more on that next. This is Bloomberg. Optimism spreading. European stocks open higher as traders gauge the health of China's economy. But the IMF is warning 1/3 of the world will fall into recession this year. COVID struggle. Xi Jinping warns that tough challenges remain in China's battle against the virus. But signs emerge, infections may have peaked in some major cities. Plus, missing the mark. Tesla falls pre-market after quarterly deliveries miss expectations. That's despite offering rare incentives in the U.S. and China. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's talk about Turkey. And inflation there decelerated at its steepest pace in more than a quarter century. Consumer prices rose at an annual 64.3% in December. That's down from 84.4% in the previous month. That all according to data released by the government today. Joining me now is Bloomberg's Turkey Bureau Chief Onur Ant. So, Onur, how much of this inflation slowing is simply just base effects from what we saw last year?
Pretty much all of it. Turkish inflation in December 2021 was massive because of a sudden depreciation of the currency of lira, which made imports a lot more expensive and fed into prices. So that steep fall that we saw in inflation rate this morning from December is largely, if not all, a reflection of high base of prices from a year earlier.
Given that, does this change anything for monetary policy, which has been unorthodox to say the least?
Probably the implications for monetary policy will be very subdued. As you said, Turkish interest rates are already quite low compared to the current level of inflation or the expected path of consumer price increases. Where we expect to see the change, the real change, is going to be the fiscal side. Between now and the general elections scheduled to take place in June, we expect to see a big ramp up in spending by the government to keep growth strong while trying to keep consumer prices under control to the extent it's possible.
So what does that then mean, Onur, for the near-term inflation outlook in Turkey?
Near-term inflation outlook is quite different depending on who you ask for their outlook. The government expects to see the inflation rate at around 22% by the end of this year. That's quite low compared to the median forecast in survey of analysts who expect to see the inflation rate at around 44% at the end of this year. Now, we expect the sudden steep fall in inflation rate to kind of stall, and we expect the price increases to sort of follow a more gradual path going forward, thanks to the expected spending by the government that I just mentioned. We expect the fiscal side to basically keep prices at elevated levels going forward.
Okay, Onur, thank you very much. That's Bloomberg's Turkey Bureau Chief, Onur Ant. Now, Bank of Israel Governor Amir Yaron says inflation is likely to start falling after February and sees an economic slowdown, but not a recession in Israel. He spoke to Bloomberg's Yusuf Gamal Eldin.
We are determined to bring inflation down back into its target, which in Israel it's 1 to 3%. We are currently at an inflation of 5.3%. We have done a very decisive front loading, and as you said, we are at 3.75. We believe we will still see inflation on an annual basis going up in the next 2 months, but then afterwards, modestly declining, and then even more so declining back in the second half of 2023 into the target rate. We understand it's painful for many of the citizens who've taken mortgages, but this is a step that must be done in order to prevent further pain down the future.
Where do you see green shoots for inflation moderation when you look at the data sub-headline? Where would you argue things are beginning to show a real improvement?
Well, we are seeing still strong, we're seeing inflation in many and wide array elements or sub-elements of the CPI. We are seeing it in the non-tradables, and this is why we still have taken a 50 basis point hike. On the other hand, if we're looking at the 6 months inflation, we are seeing some elements of moderation, and this is why we believe that after February, towards the end of the first quarter, we will see inflation in Israel starting to progressively go down. But this obviously will be affected by many factors, such as exogenous factors, what is happening around the world in terms of slowdown and in terms of supply chains farther coming down, and in terms of internal things in Israel, what kind of a budget will be put in place, how large of a fiscal expansion there will be.
The IMF came out with a dire warning on the global economy for 2023, specifically those that are likely to face a recession. I'm wondering whether the team at the Bank of Israel has been able to quantify the probability of a recession in Israel.
Yusuf, this is a very good question. Israel is not an isolated island. We are an open economy that's highly dependent on the global economy and the major blocs. We have lowered our, the GDP forecast for 2023 from 3.5 to 2.8. I want to remind you that Israel has had 2 successive years of very high growth. We are expecting 6.3 in 2022, and it was 8.3 in 21. So stepping down to 2.8 is a major slowdown. Having said that, in an international and global perspective, this is still a pretty high growth, and it clearly is affected by us internalizing the fact that there is a slowdown in the U.S., there's probably a more immense or maybe even a recession in Europe, which are highly affecting us. But still, 2.8% is a slowdown, but it's not a recession in Israel. And we're expecting in 2024 to go back to 3.5%, which is not very far from our potential growth.
Governor, I was talking to my team, and we looked at some data that showed that the Israeli shekel had its worst year since 1998 against the US dollar. A year before that, of course, there was quite a bit of outperformance for the Israeli shekel. How do you find this middle ground, and where does it feature in your calculus for the remainder of this year, given your fight against inflation?
First of all, the shekel has been very volatile throughout the year. Even just in the last quarter, it's visited somewhere around 3.38. Now it's just around 3.5. The shekel in relatively high frequency is very much tied to what is happening in the S&P 500, partly because of the large sums of money that our institutional investors are invested abroad. On the other hand, there are other fundamental factors, such as the surplus in the current account, the FDIs that are invested in Israel, and the high tech. And we will have to see how that balances out. Of course, a depreciating shekel puts some pressure on inflation. And if we see it really deviating to the point where it is really, really stressing out of bounds the pressure on our forecast for inflations, we have the tools to also deal with that within our arsenal.
That was Bank of Israel Governor Amir Yaron. I want to give you a quick look at what the natural gas complex is doing at this moment, because we see continued declines, especially in European natural gas. Well, both U.S., which is the top one there, and European. European futures, those are falling by some 4%. That's Dutch front month futures. That's now at its lowest level since February of last year. So, in other words, it's the lowest since pre-invasion of Ukraine. The same forces are happening in the U.S. Nat gas in New York is also at its lowest since February of last year. This is because of unusually mild temperatures. In Europe, we're expecting temperatures to be higher than the average for the next 2 weeks. In the U.S., it's higher through mid-January as well. All of that allowing some relief, and is possibly some of the reason we're looking at bonds rallying as well this morning. Germany 10-year yields, for example, those are off by about 7 basis points. They also rallied yesterday as well. Bonds pushing higher in the U.S. 10-year yield lower by 13 basis points. Perhaps if the energy complex isn't as bad, inflation won't be as bad as well. That follows on, of course, that the Federal Reserve won't have to be as aggressive hiking rates. Same with the ECB, though, of course, we heard from Nagel over the weekend, yesterday, and Christine Lagarde saying that they are concerned inflation expectations will become entrenched, and therefore they need to continue hiking rates. But at the moment, nat gas, both in Europe and the U.S., falling further to February 2022 levels. Coming up, the yen advances to a 6-month high versus the dollar, with Japan's decision to raise its bond yield cap stoking bets that the nation may tighten policy even further. That's next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. The yen has advanced to a 6-month high versus the dollar as Japan's decision to raise its bond yield cap last month has started to stoke bets that the nation may tighten policy even more. Let's bring in Bloomberg's chief North Asia correspondent, Enda Curran, for more on this. So, Enda, this, of course, the gains in the yen comes off the back of the BOJ spending the most to defend the 10-year yield on record. So what do we make of a yen that continues to gain despite the BOJ doing and saying something different?
Well, it's a big reversal. Remember last year, the yen was being written off as a safe haven currency, kind of a pivotal turning point for Japan's economy. But like you mentioned, there are a few things going on now. First of all, of course, there's been support for the currency from the government and the central bank. There is a lot of illiquidity in the foreign exchange market at the moment, with Japan being out. That means it's kind of gapping higher a little bit. Dollar strength coming off the ball is also helping. But as you say, a lot of it comes down to the Bank of Japan and this idea that maybe they are now shifting just before Christmas. Remember, they made that decision to lift the cap in their bond yields a little bit. That stoked some expectation that they are now moving away from those very dovish policies because of where inflation is at in Japan. Others, of course, argued it was merely a move to try and offset the illiquidity in the bond market, given the massive BOJ intervention there. Regardless, the end result, along with these other factors I mentioned, has been that the yen is where it's at now. It's rallying. A lot of investors say it should never have been written off anyway, and the stronger yen will probably be welcomed by the Bank of Japan in terms of its impact in keeping a lid on imported inflation.
And you mentioned some of the difference of opinions. Is there any strong consensus as to whether we see a change in BOJ policy this year?
Difficult to say because we'll have a new governor in the months ahead, Danny. Governor Kuroda will be stepping down. There will be somebody appointed to replace him. There's some discussion around what kind of an agreement might come out of that between the Bank of Japan and the Finance Ministry. Will there be a material change to the Bank of Japan's mandate? These are all the talking points at the moment. There was a view that maybe Governor Kuroda was kind of getting the house in order for the incoming governor by making that move on the yield curve control that I mentioned that he did just before Christmas, and perhaps now we're in for maybe a quieter few months. But regardless, with Japan, there is a lot of focus on the very dovish policy that Governor Kuroda has doubled down on. Even though inflation is proving to be stickier than expected, he continues to say it's mostly tradable. A lot of it is down to the price of oil that Japan imports, for example. Others are saying that BOJ really needs to move away from this massive support that it continues to pour into the economy and tighten policy a little bit. So these are all talking points in the months ahead, but the big change for the Bank of Japan is expected to come when the new governor takes over, and of course he or she will then signal what way he or she wants to take policy in the months ahead.
And when it comes to this global economy, we continue to hear warnings, it feels like every single day, that there will be a recession. As to whether it's mild or not, that's a different question. But the IMF's Georgieva is the latest to contribute to that, saying that a third of the world would be in a recession. How in line with that is it with investor expectations, with economist expectations more broadly?
I think broadly it's in line, Danny, because we know what's going on in the three big blocks. The China COVID-0 story is kind of well understood in terms of the impact it's having on consumers and on businesses there. Europe, of course, is getting the spillover from the Russia war in Ukraine. And the US story is all about Fed raising rates, the economy slowing down as well. But, you know, as you say, there are those making a contrarian argument now. There's a viewpoint that once China navigates the public health aspect of its exit from COVID-0, you might start to see consumers rebound, manufacturers get going, and the economy gets on its feet again. You know much better than I that in Europe there's talk there of the milder winter and the impact that's having on gas prices. And of course in the US there's a view that the labour market remains strong. We'll get job payrolls on Friday, and as long as that remains strong, perhaps the US might pull off a soft landing. So yes, a lot of concern for where the world economy is headed, given everything, the conditions that we saw through much of last year. But as I say to you, there is this counter argument that perhaps there might be some upside surprises in the months ahead.
Yeah, natural gas in Europe at the moment, it's lowest since February of last year. Enda, thank you very much. Bloomberg's Enda Current there. Let's get your Bloomberg Business Flash now. With that is Laura Wright. Good morning, Laura.
Thanks, Danny. Tesla deliveries fell short of estimates in the latest quarter, despite offering large discounts in the US and China. The electric car maker handed over just over 405,000 vehicles to customers, below consensus Bloomberg forecasts for around 420,000. While the total was a record for Tesla, the firm came up short of its goal to grow deliveries by 50% last year. UK rail workers will walk out for much of this week, disrupting the usual return to work after the holidays. Unionised railway staff will strike for 5 days from Wednesday, with nurses and ambulance drivers, among others, also due to take industrial action later in the month. The protests stem from growing anger over the tightest cost of living squeeze in decades. China Evergrande Group has vowed to repay debt in 2023 after again delaying announcements of a much-anticipated restructuring plan. In a New Year letter to staff, the property developer's chairman says it's a crucial year for Evergrande to deliver residential projects it pre-sold. He added that construction resumed last year for all of its more than 700 real estate sites. SpaceX is reportedly raising $750 million in a funding round that values the company at $137 billion. CNBC says Andreessen Horowitz will be the lead investor, having previously backed the space transport company run by Musk. Last month, sources told Bloomberg SpaceX was offering insider shares at $77 apiece, valuing the company at about $140 billion. That's the Bloomberg Business Flash. Danny.
Laura, thank you so much. Coming up on the program, after the biggest loss for 60/40 portfolios since the global financial crisis, better days may lay ahead for the trillion-dollar complex of balanced investment strategies. We'll discuss that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. After the biggest loss for 60/40 portfolios since the global financial crisis, better days may lay ahead for the trillion-dollar complex of balanced investment strategies. Amid an optimism that inflation has peaked, more than 60% of respondents to the latest MLive poll survey are betting that stocks and bonds will move in opposite directions this year. Joining me now is Heather Burke from our Bloomberg MLive team. So Heather, it's not just 60/40 that did poorly. The element of stocks in there, its worst year since 2008. You have a cracking piece out, your outlook for the S&P 500 for this year. What are you expecting?
We're expecting some small gains. The MLI Pulse survey forecasted the S&P to end about 2023 about 4,000. That would be about a 4% gain from, yes, indeed, a horrible year for stocks. We expect, a tough first half of the year. We expect earnings to keep falling. The macro backdrop is still tough. That being said, we see improvement in the second half of the year. Consumer confidence stays still strong. The job market's still fairly robust. And we'll see those earnings start to turn positive again year over year by the fourth quarter, which should underpin, the small gains that we're expecting.
Okay, so that's the stock side of things. When it comes to bonds, in the survey you took of MLive readers, what was the overall view? I mean, does it come back, for example, as a hedge against stocks when they were correlated for the past 2 years?
Yeah, I think bonds will come back as a hedge. Our survey found that the 10-year Treasury yield could end next year at 3.5%. There was a high of 4.24% in 2022. So we do see, and again, the big finding is that we see the stocks and bonds moving in opposite directions, and that should help balance portfolios. Back in 2022, we saw in a lot of cases both falling, breaking that traditional relationship on inflation fears. We're hopefully going to see some inflation starting to ebb. We're starting to see that in Europe. We've seen that with the US CPI. Obviously, it's still far from the 2% that central banks like the ECB would like to see.
Right. So how important then to that view is what the Fed does from here on out?
I mean, our survey expect the Fed funds to peak about 5% to 5.25%, which is kind of what we've seen sort of in other forecasts. That being said, people are seeing a Fed rate cuts in 2024, which, the Fed is saying we're a long way from seeing those, especially with inflation still running so hot.
Okay, Heather, thank you very much. That's Bloomberg MLive's Heather Burke with the latest MLive Pulse survey. MLive goes where you want to head on your terminal to get analysis from Heather and the rest of the team. Energy prices, natural gas, they continue to fall in both Europe and the U.S. Dutch front-month futures and New York-listed nat gas, those both at the lowest since February 2022. So that is pre-invasion levels. That's because the weather, it is mild. That potentially may help us avoid the worst of a recession. Of course, I was talking to Fiona Bull from S&P Global earlier, who said it is not this winter you need to worry about, it is next winter. Even so, that is allowing risk on to reign supreme when it comes to the cash equity trade for Europe. Those shares, Europe Stock 600, up nearly 2%. It is the second day of gains for the European index. It will be its best two-day gain since November of last year. You're also looking at a 10-year yield that is coming in. Maybe there still is some haven buying happening here. Those yields lower by about 13.5 basis points, but that could also just be energy coming back in. Less inflation, less rate hikes needed. 3.7389 is where you stand on your 10-year yield. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kailey Leinz in New York, and Anna Edwards here in London. This is Bloomberg.
This is going to be a tough year, tougher than the year we leave behind.
The Chinese economy is doing quite poorly. Zero COVID is a major contributor.
And it has not been an easy journey for anyone. We have now entered a new phase of COVID response where tough challenges remain.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. China's economy ends the year in a slump as the COVID outbreak is blamed for a plunge in business and consumer spending. But have cases peaked in some urban areas? Tesla's year-end discounts aren't enough. Elon Musk's electric car maker sets a record for quarterly deliveries, but the total still misses estimates. And maybe the global natural gas crisis won't be that bad. A warmer than expected start to winter is easing fears of shortages and skyrocketing bills. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, there seems to be a long list of things for investors to worry about in 2023, but investors didn't get the memo this morning, certainly buying risk on both sides of the Atlantic.
Yeah, definitely a strong start to the year for equity markets really around the world, something that began in Asia overnight where most stocks were higher. Japan was closed for a holiday, but we actually saw gains in Hong Kong and China after being down at the beginning of the session. So as a result, the MSCI Asia Pacific Index as a whole up about 0.5%, and the Chinese CSI 300 ended the day higher by about 0.4%. Interesting, though, to see Chinese assets catching a bid after the data we got over the weekend. PMIs for December showing a deepening contraction in the Chinese economy. You saw a deeper slump in manufacturing. The services gauge actually slumped the most since February of 2020, which really goes to show you the effect of the unleashing of the Chinese people, the abandonment of COVID zero policy, and the surge in COVID cases seen as a result. But maybe some optimism is around the fact that when you look at mobility data in certain cities, it shows that we are seeing a rebound, maybe signaling a peak in cases. So that may be what risk appetite those who want to buy risk are clinging on to, and that is definitely true for the offshore yuan as well, which is strengthening against the dollar this morning to 6.91. Also strengthening against the U.S. dollar, though, off of the strongest point of the session is the Japanese yen. Currently, dollar yen trading at 130.48. We actually were below that at the strongest level in 6 months earlier on in the session, Matt. Really interesting to see the FX market pushing back against the BOJ, clearly betting that they are going to have to make more tweaks, perhaps, to yield curve control.
Yeah, I think very fascinating. The BOJ, listen, it was one of the most interesting stories of 2022 and will continue in 2023. But also fascinating to me is that you've got the yuan and the yen down against the dollar, the greenback up against pretty much everything else. Here you can see on the third row the Bloomberg US dollar index, or for those of you listening on radio, I will walk you through it. Right now we're at 12.55. That's up 0.7%. So the dollar really strong, which is counter to what we see in the Asian, at least the Asian major currencies, and also in terms of S&P futures, we're looking at a big gain right now, 1.1%. And typically when you see a big gain in the U.S. dollar against other major trading partners, that puts a damper on risk appetite. You typically see then futures down at this time or the cash trade falling, and right now we just don't see that. The U.S. 10-year yield coming down, 370 is the level there. So investors are buying bonds as well as stocks. It's interesting because in an MLive Pulse survey that we're going to talk about, investors expect 2023 to reverse that. So to go back to the time-honored inverted relationship of stocks and debt, so that they sell debt when they buy stocks or vice versa. I also want to point out gold here, up 0.7%. 1838 a troy ounce is the level. And I'm going to start putting gold or other commodities here, Anna, instead of Bitcoin, because it just hasn't moved since the collapse of FTX. Without looking, I'm going to say we're at 16,700 and change. And that's going to be the case, or has been the case at least for the last 5 or 6 weeks.
Yeah, absolutely. I think it was 16,700 and change last time I looked, Matt. I'm sure we'll put it back in there if it starts to move. What is moving today, though, Matt, is European stocks in conjunction with US futures. We are seeing some real strength coming through in Europe today. We have the London market playing catch up, but even in the continental European markets, which gained by 1.7% in yesterday's session, we're still seeing more room for positivity. And in fact, some of these markets up by nearly 1.5%, the German and the French market in amongst them. Let's have a look at some of the assets I pulled out to talk about today. And in there, the FTSE 100, it is playing catch up, as I mentioned, because it was closed yesterday, but up by more than 2% now. And in fact, if you look at this index, only one stock on the FTSE 100 is in negative territory. That's how broad-based the positivity is for global stocks today. And for FTSE 100, it is actually a gauge of global stocks and not necessarily the UK. Here's the travel and leisure sector. This is one sector that's doing really well. So this is airlines, it's aviation, it's gaming companies as well, but it is very much the aviation side of things that is pushing this sector higher today, up by more than 3%. A note out from Citi talking about how they like long haul over short haul, but that doesn't stop both of those parts of the aviation space from rallying today. The euro is weaker, down by just over 1%. Really, this is the strong dollar, though, that Matt was talking about, the strong dollar story. 105.53 is where we trade, but there is some data out of Europe that's of note. We'll get the inflation print for the Eurozone a little bit later on this week. We'll get Germany's inflation print later on today, but we've had 5-6 regions of Germany already reporting, and most of those showing that the inflation rate year on year has dropped by more than 1 percentage point compared to the previous month. So moving in the right direction in terms of getting a handle on inflation. inflation. And here's one of the reasons why. The natural gas price continues to fall, down by another 4.6% after the drop yesterday. And it does seem as if the weather forecast from here then, Matt, are for more mild weather, at least in the week or two ahead for continental Europe. And that could be, again, good news for the economy and indeed for gas prices.
Yeah, definitely prices that caught my eye over the holiday weekend. Let's kick off, though, with what we saw in terms of China. Economically, the year ended in a major slump. Business and consumer spending plunged in December, with more disruption likely in the coming months as COVID infections surge. China's President Xi Jinping recognized the challenges ahead in a New Year's address.
With extraordinary efforts, China has prevailed over unprecedented difficulties and challenges, and it has not been an easy journey for anyone. We have now entered a new phase of COVID response where tough challenges remain.
Enda Curran, Bloomberg's chief Asia economics correspondent, joins us now from Hong Kong. And Enda, the reopening seems to, have question marks on it still, because the economic slump that we all saw at the end of China is, in some ways, belied by a jump in high-frequency data.
Yeah, so two ways of looking at it. On the one hand, Matt, the economic hit has been deeper than expected. We had PMIs out over recent days, both official and private sector, showing that the manufacturing sector remains in the doldrums, and the services side of things took its biggest hit since February 2020. So December was a bad month for the economy as China transitioned the exit from COVID zero. However, to your point, we are now getting some more high-frequency readings on subway usage, for example, in key cities. That's showing a pickup in the number of passengers taking those subways. That, of course, lends itself to consumer confidence, and maybe people are getting out and about again. And some suggestions that perhaps the disease is peaking in certain parts of the country. Likewise, industrial production in, for example, the famous iPhone city in China, back up towards 90%. But that said, we're obviously still very early in this exit from COVID zero for China. The public health story remains number one. The economic story is expected to stay very choppy, and we won't get much clarity on the economic recovery until perhaps sometime in the second quarter.
Well, and Enda, as Matt and I both mentioned, with that as the backdrop, you are seeing the offshore yuan gaining against the dollar, and the other big Asian currency also gaining is the yen, which hit its strongest since June earlier on in the session. Some pretty significant pushback, I would say, to the Bank of Japan. What are the odds that Kuroda actually gives in?
Well, it's a big turnaround for Japan. Last year, the story was the yen was being written off as a safe haven. Here we are now back at its high since June. There's a big rally underway. Some investors saying that there's plenty more upside to go. It does reflect, of course, illiquidity in the market given the holiday time of year. It also speaks to the idea, though, that perhaps the Bank of Japan may be moving away from some of its most dovish policies. We know what they did before Christmas in terms of lifting the cap on their bond yield program. Some say that they will do more in the coming months to move away, given where inflation is where it's at. The Bank of Japan, of course, continues to double down on its dovish message. They don't believe inflation is going to be very sticky, and they say the economy needs more support. But there's no doubt that as we start the year, the yen is certainly in a very different position than where it was as recently as September, when many big investors were betting against it.
OK, yeah, times have changed, haven't they? Certainly at the end of last year. Enda, thank you very much. Bloomberg's Enda Curran with the latest on the Chinese growth story and indeed the Japanese currency moves. Let's go from Asia stories into the United States. And Tesla delivered fewer vehicles than analysts expected last quarter. Joining us now with analysis is Bloomberg's Craig Trudell. Craig, good morning to you. Good to see you. So this was a record quarter of deliveries for Tesla and a first month over 400,000. But what? That's not good enough, it seems.
Yeah, and it's not just the case of not meeting Wall Street's expectations. It's actually the expectations that Tesla set as well. You know, they talked during the last earnings call about being just under the 50% growth rate that they've said they expect to average over several years. They came in at 40%, so not particularly close to that number, and also, you know, falling short despite the fact that they did something very unusual at the end of last quarter, which was, you know, offer pretty substantial incentives both in the U.S. and China. So this is a case of you know, demand concerns that the company, you know, was having trouble sort of, you know, batting away, only being sort of reinforced by the performance at the end of the year.
So we've also seen Elon Musk tweet a couple of times in this fresh new year about a setback related to U.S. tax credits. What's he talking about?
Yeah, so this has to do with the Inflation Reduction Act. There was obviously a lot of expectation of, just how many electric vehicles would be eligible for tax credits under that law. Obviously, Tesla and General Motors were, potentially going to be big beneficiaries because they had hit a cap that, basically led to their incentives running out. The problem is the way that the IRS is limiting ability for some of Tesla's models to be eligible because of some minutia with regards to how they treat the Model Y. Some versions of the Model Y they categorize as a sedan and others as an SUV, depending on whether or not it's a 5 or 7 seat version. And so there's some concern as to whether any Tesla models will be eligible for the IRA unless the company cuts some prices. So, that obviously is something that was, hoped would boost demand in the first quarter. And there's now some real doubts as to whether or not that will be as much of a tailwind as hoped.
All right, Bloomberg's Craig Trudell, thank you so much. Now, let's turn to the commodity space. A warmer than expected start to winter across large parts of the world is rapidly easing fears of a natural gas crisis. Rachel Morrison, Bloomberg's editor for Power, Gas, and Renewables, joins us now. So, Rachel, are fears of a cold snap over? Can we expect prices to continue to cool for the winter?
Well, what we've seen is a really mild start to this year, and demand has fallen as a result of that. And we expect that usually over the holiday period. But even at the beginning of this week, we've seen prices continue to fall, and the weather forecast does look mild for this week and sort of into next week. Ahead of that, it's less certain what will happen. But what that allows us to do in Europe is to rebuild gas storage supplies. So instead of withdrawing from storage, while the weather's been like this, we've been able to put gas back in. So even if it is cold, even if we do get another cold snap, because we can't rule that out, we always use the example of the beast from the east, which came in March, when you sort of think the worst of winter is usually over. So even if that happens, the more gas we have in storage, the less of an impact it will have on prices. What will be interesting to see is last year the price trend reversed, where we had much higher prices during the summer when we're usually refilling gas storage. So depending on how much we use and what levels are like at the end of the winter, we'll see what the summer will be like. But just because it's mild weather now doesn't necessarily rule out higher prices later on. But for the moment, it does look better than people feared.
Okay, and Europe has been, of course, Rachel, the epicenter of concerns around gas supplies, given the supply issues with Russia. Are European fears of a Russia-induced supply crunch fading then? I mean, so little is received from Russia, if anything, now, and so alternative plans have been made for this winter at least. I mean, structurally, bigger changes needed for winters ahead.
Yes, that has been quite successful in that Europe has been able to secure alternative supplies. And as we go further on, there becomes less that Putin can do. However, there are still some gas that transits Ukraine to Europe. And there are still worries that shelling, and as the war goes on there, that infrastructure could be damaged, and that could halt those flows. Although we sort of think that could provide a bit of a short-term shock to prices, but then ultimately Europe should be able to continue to get supplies of LNG, mainly what we've replaced pipeline Russian gas with. However, where the cold weather does have an impact globally is if there's colder weather in Asia, in the US, and it makes it more difficult or more expensive for Europe to get supplies of LNG, then obviously our prices will rise too. So perhaps there is less of an impact from action that Putin can take. However, there's still very much a global story to what will happen to gas prices.
All right, Bloomberg's Rachel Morrison, thank you so much. Now let's get back to the U.S. equity market and take a look at some stocks moving in pre-market trading. We were talking about the China story with Enda a moment ago, and really optimism around the idea that COVID cases may be peaking, at least in some areas, is lending a hand to stocks sensitive to that story, including Wynn Resorts, which is a big casino operator, heavy revenue exposure to Macau. It is up about 3%, and you're seeing some of those Chinese technology companies, those ADRs gaining as well, including Alibaba and JD.com. Vietnam, which are each higher by the better part of 3% too. Now, it's not just Chinese tech that is gaining in pre-market trading, but mega-cap U.S. technology is as well. After what was a brutal 2022, you are seeing the new year starting off a little bit better for some of these names. Alphabet is up 1.6%, Amazon by 1.7%, and Nvidia up by 2%. And of course, both Amazon and Nvidia were down by 50% last year, Anna. So we'll see how this first trading session really sets the tone for these names in the year ahead.
Yeah, it's interesting to see how the European sectors that are gaining the most today are some of those that were beaten up last year. Travel and leisure, technology, as you mentioned, Kailey, also real estate. Coming up on the programme, we will talk about 2023 and the investment outlook. Hans Olsen joins us, Fiduciary Trust CIO. We'll get his perspective on the year ahead. And on their top risks for the year, we'll be speaking with Eurasia Group's Chairman, Kupchan. We'll talk about the year ahead. We'll also look back at the risks they identified last year and see how well they did with those. Plus, Wall Street's year ahead. Today's Big Take story gathers more than 500 strategists' calls to help paint the upcoming investing landscape. Look for that online or on Bloomberg or on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York and Anna Edwards out in London. Happy New Year, everybody. Now, Michael Burry, made famous by Michael Lewis in his book, The Big Short, and played by Christian Bale, of course, in the movie, put out a fun-filled tweet that I think we need to dissect a little bit. I've got it up here on the screen. He says, yeah, inflation peaked, but it's not the last peak of this cycle. He says we will go lower and maybe even negative in the second half, and the U.S. will be in a recession by any definition. He doesn't give a date there, but sometime in the future, the U.S. will be in a recession. I guess it's implied that it's the second half. The Fed is going to have to cut, and the government's going to have to stimulate with some fiscal I guess, helicopter drops. Let's get to Justina Lee right now, joining us to talk about this and markets in general. Justina, it's really interesting that Michael Burry comes out and says the Fed's going to have to cut because we're going to go into such a deep recession in 2023. Does that jive with consensus?
Yeah, that's a really big call there. But I think one part of the tweet that's really hitting at some of the big themes this year is the call for a recession. Now, if you look at all those Wall Street outlooks that they put out, I mean, that word does come up a lot. And it's one reason why a lot of strategists are expecting at least a better year for bonds, if not stocks. But I think the more controversial part of that tweet is the call for a rate cut. And now that is currently priced in the derivatives market, but we have seen Fed officials trying to push against that narrative. I mean, talking a lot about how they will need to see a persistent slowdown in inflation before they even think about stopping their monetary tightening campaign.
Justina, good morning to you and Happy New Year. You mentioned that because of these expectations around a recession, many strategists are talking about what bond markets might manage to achieve. And I know the Markets Live team had a survey out that surveyed hundreds of investors and got their thoughts. And they did indeed suggest that bonds would stage a comeback as a hedge against stock losses. So what's sort of ahead for the 60-40 portfolio then in that context?
Well, that will at least be very good news because one big problem in 2022 was that bonds and stocks fell together. So that correlation turned positive. But if we at least get a rebound in bonds, I mean, you have that buffer back in your portfolio, even if it's a worse year for stocks. And that's certainly something that a lot of strategists have been talking about.
Okay, Justina, thank you very much. Bloomberg's Justina Lee with the latest on the markets. And for more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal to find the Markets Live blog. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. Ukraine struck a Russian military facility in an occupied town, killing at least 63 troops. It's one of the deadliest losses acknowledged by Moscow. Russia says the facility was hit by 4 U.S.-made rockets. More troubles for UK Prime Minister Rishi Sunak. British rail workers will walk off the job for much of the week. They'll strike for 5 days starting Wednesday. Nurses and ambulance drivers plan to strike later on in the month. Unions are demanding bigger pay hikes to deal with record inflation. And in the National Football League, Buffalo Bills player Damar Hamlin suffered a cardiac arrest and collapsed on the field during a game with the Cincinnati Bengals last night. Hamlin, who is just 24 years old, is in critical condition in a Cincinnati hospital. Stunned teammates surrounded him while he was being treated by doctors and paramedics on the field. The game was postponed. Coming up, we will turn back to the markets and get the 2023 investment outlook from Hans Olsen, Fiduciary Trust CIO. Does he agree with our Bloomberg MLive survey that shows somewhat of a comeback for the 60-40 portfolio once again this year, and bonds and stocks acting as a hedge against each other? That's next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China's economy ends the year in a slump as the COVID outbreak is blamed for a plunge in business and consumer spending, but have cases peaked in some urban areas. Tesla's year-end discounts aren't enough. Elon Musk's electric car maker sets a record for quarterly deliveries, but the total still misses estimates. And maybe the global natural gas crisis won't be that bad after all. A warmer than expected start to winter is easing fears of shortages and skyrocketing bills. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European stocks, US futures, all suggesting a buoyant risk appetite, I suppose, as we start 2023 at least.
Yeah, I guess that's got to be the market headline, right? US stocks, European stocks set to kick off 2023 with a rally. And we do see futures higher this morning. Right now, about 0.9% on S&P futures at 38.95. Now, it's interesting because you have investors buying futures at the same time that they're buying bonds. That pushes the yield down, and buying the dollar right now up about 0.8%. And we have been expecting, or at least an MLive Pulse survey expects that the stock and bond picture will diverge in 2023, which is the way it's supposed to be, according to Economics 101. As stocks rise, investors buy stocks. They take that money from bond holdings or sell bonds to fund that trade. Also, you typically see people buying bonds as a safe haven, and that means they're scared of stocks. So it's interesting to see them still moving in the same direction today. We have seen the Bloomberg Dollar Index. Last year, the incredible strength in the dollar really also worked against risk assets. So when you saw a strong dollar, that meant you saw a sell-off in stocks. We don't see that happening on the first trading day of the year. I also want to point out that gold continues to gain strength at 1836. It really hadn't acted as the inflation hedge it was supposed to be throughout the runaway inflation we saw in 2022. And it'll be interesting to see how gold holds up as the Fed continues to raise rates into this year. Kailey, what do you see in terms of pre-market movers?
Well, that move in yields is really noteworthy, Matt. 13 basis points down on the day, and that is giving a hand to some of those high multiple mega cap technology stocks. Though one is sitting out that rally, and that would be Tesla. The stock is down about 3.7% right now after we got fourth quarter deliveries data over the long weekend. And even though it was a record quarter, above 400,000 cars delivered, it missed Tesla's own expectations and the expectations of the street. And that was despite really heavy discounting that Tesla did in many of its major markets. So once again, fueling concerns about demand for those electric vehicles. The stock adding to the declines we saw last year, 65% down year yet last year in 2022, worst year for the stock on record, and 2023 doesn't look like it's going to start off materially better. But for other technology stocks, you are seeing the benefit of lower yields. You have Amazon, Microsoft, and Apple all higher on the day, Anna.
So, Kailey, then into the European session, and it's interesting what you're saying there about technology, because that's one of the sectors doing well here in Europe. Some of the sectors beaten up, of course, by the higher rates environment last year, actually doing pretty well today. So whether that's technology or real estate, those two sectors, along with travel and leisure, doing best out of the sector outlook. So Stocks Europe 600 up by 1.6%. I pulled the FTSE 100 out. It is playing catch up from yesterday. European continental stocks were up by 1.7% on a day where London was closed. So London having to play catch up, and so as a result, getting some of the best of the gains. And it's really broad-based. Around half an hour ago, only one stock was in negative territory. Now only 3 stocks in negative territory out of that FTSE 100. The stock rally coming despite, as Matt says, the strength that we're seeing in the dollar. The euro weakness, the strength in the dollar takes us to 105.39 right now. And we have had some interesting data out around the German inflation story, showing it coming off its peak in various regions of Germany. We get the national figure a little bit later on today. Then we get the Eurozone figure at the end of this week. week. So there's a real focus on whether that inflation figure has peaked. Christine Lagarde's comments, though, over the weekend certainly suggest ongoing focus on the inflation fight over at the ECB. And perhaps some of the reason for optimism around inflation and the battle there, natural gas prices coming down once again. We talked to our colleague Rachel Morrison earlier on in the hour, Kailey, about this phenomenon. It seems the relatively milder weather over the winter so far setting us up, at least, or putting us in a good place, I guess, as we go into 2023.
All right, Anna, definitely a story we will watch this year. And speaking of the story for 2023, in this week's MLive Pulse survey, market participants weighed in on how exactly they see this year shaping up for markets. Here's a quick look at what a few of our guests had to say about their expectations.
When you have sharp movements in markets, those correlations rise. When you have sideways moving markets, as I anticipate is going to be the trend in 2023, that correlation will break down. And I think what you are going to see is investor flows being driven by market selection.
Our long-term models were very negative on equities at the beginning of this year. But the good thing about this correction that we've seen in the market, the good thing about valuations coming down, is that the setup right now is spitting out something like 5% returns per annum over the next 10 years.
Due to the fact that bonds have likely bottomed and rates have likely peaked in this cycle because markets are so anticipatory, then I do think that the 60-40 performance is going to improve next year.
Many in the market saw this as an opportunity to actually either top up existing positions or enter into positions in Micron in particular. And that's a view that we would share. This long-term structural growth story, by no stretch of the imagination, is that going away anytime soon.
So a comeback for the 60-40 portfolio, perhaps after its worst year since 2008 in 2022. So joining us now for more on the 2023 outlook is Hans Olsen. He is Fiduciary Trust CIO. Hans, Happy New Year to you. Thank you so much for joining us to kick off 2023. How are you thinking about how you want to split your allocation between stocks and bonds in this year?
Sure. I think, first of all, Happy New Year. I think the way that we're approaching it right now is that we have raised cash over the closing months, the closing second half, of 2022, in anticipation of what was going to be a rough back end of the year. And so we sourced that cash from both equities and fixed income because we thought both asset classes would suffer from the reset in interest rates that are ongoing. And as far as 2023 is concerned, I think you're right. We'll see a return to some good performance, a somewhat reasonable positive performance out of the 60-40 stock bond portfolio, but it'll be back-end loaded if it happens this year. And that all will be a function of ultimately where interest rates land and in the effort of getting inflation down.
What do you expect in terms of inflation? We were talking about a Michael Burry tweet earlier where he said we're going to have a peak again, but then could see it dropped down even to negative territory in the second half. I guess he's predicting a horrible recession where the Fed has to step in and cut rates and the government has to provide fiscal stimulus.
Yeah. It's an interesting question because I keep thinking that we will end, with the idea of rearming, reshoring, and restocking, which is an ongoing effort through the American economy. We'll see inflation settle in somewhere in 4 to 5%, so materially above where the Fed hopes it will be. But I think ultimately, if we get to a point where we get a real interest rate reasserting itself in the economy, that'll be the beginning of what normal looks like. So I don't see a return to deflation. And I think the question about it, do we have recession or not? It was interesting to note in the IMF note, was yesterday, where the director was talking about a third of the world's economies being in recession. She did note that the one exception was the United States, whether it would fall into recession or not, because our economy is so resilient.
Yeah, so that's still an open question then. Hans, good morning to you. If we do see inflation settle in the US at between 4 and 5% because of some of the trends that you mentioned, the reshoring, the restocking and the like, what is the impact on investment strategy of an inflation rate that is that high by recent standards but low by longer term standards, I suppose?
Yeah, that's a good point. You think about I mean, you have both level and direction. So if you have an inflation rate, let's say it's 4%, but it's durably 4%, sort of stable at 4%, you can make money in that environment without a doubt, right? It's when you have inflation that's rising at a good clip that's problematic, and inflation that stays high. But if it's low and stable, and one could argue that a 4% stable inflation rate, while not perfect in the Fed's eyes, you can work with that. You can plan investment around that. And I think that's an important point for thinking about capital allocation on a longer term basis. So I think you can make, both in the equity market and the fixed income market, decent money in that environment.
We've talked a bit, Hans, this morning about how stocks are gaining this morning, despite the fact that we see a stronger dollar. Given that's your outlook for the US and where inflation settles, and that'll impact on the dollar, of course, how do you see that playing out? The stronger dollar that we've seen, the weaker dollar that some people anticipate, how does that play out for international investments?
Yeah, well, I think a stronger dollar, which I think is likely. I think we've seen peak dollar, and the reason that I say that is that you have the Europeans who that are working very hard to catch up with American central bank policy, and you even had, as you covered earlier, sort of questions around what the Bank of Japan was going to do as Kuroda leaves the post later in the year, and. So you have global tightening, and so that interest rate differential with the dollar now, with the U.S. economies coming down, the dollar as the standout currency. I think we've hit this peak dollar, and we'll see the dollar weaken over the course of the year. And so as a result, that should help foreign investments, certainly from a dollar perspective. So what has been sort of a one-way trade over the last year, relatively speaking, I think will start to reverse itself in 2023, and foreign markets, both in the fixed income and eventually in the equity market and eventually fixed income markets, will become more appealing.
Okay, so that's all in fiat currencies, Hans. I noticed in the notes you sent over to us when you were talking about assets that are still overvalued, you mentioned crypto. Does crypto have any role to play for you in a multi-asset portfolio?
Yes, it's basically an avatar of that which should be avoided at all costs.
Okay.
Yeah, no, I just,
good advice.
It is. I think with the emergence of an interest rate again, the bar for successful investing goes up, and as a result, gold will struggle. As we saw last year, it could struggle again in the first half of this year. In crypto, there's a post-mortem on that needs to be done, and that probably plays out in 2023 as well.
Okay, a book still to be written then, Hans. Thank you very much, Hans Olsen of Fiduciary Trust. Thank you very much for joining us with your thoughts. And be sure to check out today's Big Take story, which gathers more than 500 calls from Wall Street strategists to help paint a picture of the year ahead. Look for that on Bloomberg.com or on the Bloomberg terminal.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with former Prime Minister of Sweden, Carl Bildt. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Now, kicking off the new year, Eurasia Group will be publishing its annual forecast of political risks in less than an hour on Bloomberg Surveillance. Eurasia Group's chairman, Cliff Kupchan, joins us now from Washington with a bit of a preview. And Cliff, I guess in terms of geopolitical issues, one of the biggest ones is going to be the war in Ukraine. Does Vladimir Putin, does Russia continue that war, or do you expect them to come to the table with some kind of agreement that provides us with a truce?
Well, Russia not only continues that war, I mean, look, two countries want the same land, so there's not going to be an end to this war anytime soon. Putin this year has no obvious way, no clear way to win the war. He is backed up in a corner, back against the wall. And we expect him to lash out with asymmetric warfare. warfare not on the battlefield. Nuclear threats, escalating nuclear threats that have a very bad outcome if two sides miscalculate, one side miscalculates. I'm also really worried about what could happen in the south if the Ukrainians make a breakthrough. I think Putin, small chance, but he really could use a tactical nuclear weapon. That's extremely worrisome. But otherwise, I think we're going to see mostly asymmetric. And by that, I mean cyber, hitting fiber optics cables. I still think, my theory of the case on Nord Stream is that the Russians did it. I know they're making repairs. I still think they're the only one with an incentive to do that. And possibly, what I hear from my Russian colleagues is possibly hitting U.S. satellites that are engaged in the war. And that's extremely dangerous because we're talking about a war in space. So, no, I don't think the war is over. I think things are going to get much more serious this year.
Okay.
In those terms, yep.
And Cliff, worth pointing out that this time last year, you were saying at Eurasia that you thought if there were no concessions from the US-led West for Russia, then Russia will act, and they did. Right. We saw that call was entirely right. So you expect Russia to continue to lash out with what you call asymmetric warfare. Will Ukraine continue to enjoy Western support then in that context?
Yes, it will. I think Washington, the city I live in, is pretty much still focused on some form of victory. Victory as the Ukrainians define it, but the Ukrainians want everything back, including Crimea. So I think eventually we'll, in this town, again, go up the escalation ladder, providing longer range missiles, providing possibly tanks, and even possibly aircraft, F-16, which is what they really want over in Ukraine.
So
it's an escalatory atmosphere. Go ahead.
Well, obviously, Russia is one authoritative regime we could talk about, but there are many around the world. How do the links of those together come through in the 2023 top risks?
Well, thank you. That's one of our main themes, really, that a small number of people have accumulated a tremendous amount of power, and that has real implications for geopolitics. They're making these decisions, this crew, with limited information, with limited expert advice, and with no checks and balances. So as you draw across Russia to Xi Jinping in China, to Ali Khamenei in Iran, those are three countries that are pretty high on our risks, that are going to be making bad decisions that impact global markets. If that happens in China, for example, we could talk about Xi if you want. That is extremely important for investors.
Okay, well, let's do that. Let's talk about China, because we actually heard from the new foreign minister, Qin Gang, overnight praising the Americans, talking about how he has been deeply impressed with the Americans he's interacted with and that he wants to help build a stronger relationship with the U.S. What do you make of that and the idea that there has been something of a warming of ties between these two largest economies in recent months?
I think since the last meeting between Xi and Biden, both sides have decided to put a floor under the volatility of the relationship, to try to at least, competition and cooperation. And that's a change for the better. But still, as we talk about in our report, it's maximum Xi right now for the 20th Party Congress. He is it in a big way. So that from COVID, where there's a real crisis going on, and that could get even worse if new strains emerge and there's no transparency, to the economy, where they really need good stewardship this year in the context of a weak global economy. They probably won't get it from Xi's crew. And that could lead to, again, a lot more policy volatility, even pain for markets.
Well, we heard a lot about the economy this morning. I was listening to Tom McKenzie on Bloomberg Radio say that the supply chain issues have really hurt China, the supply chain issues caused by Putin's war in Ukraine. Of course, they've been allies. Does that continue, Cliff, or does Xi grow tired of Putin's war in the East?
It continues. I think that my own view is that Xi is mortified by the war. Just can't stand it. But the cost of backing out of that, friendship with no limits, which certainly has limits, but the cost of backing out of that friendship is just too high for him. He needs a very strong relationship, with a nuclear superpower on its northern border, and Russia's just too convenient. This mutual balancing against the U.S. is just too good for Xi to back out of. So it'll continue.
Cliff, given that, but given also what you talked about earlier with the increased cooperation perhaps between the U.S. and China, how do you assess risks surrounding Taiwan?
I don't think risk surrounding Taiwan is very high at all. there's been a kind of a cottage industry about writing a war in Taiwan in this country, and I've kind of been part of it, but it is way overhyped. This will be a major war between two nuclear powers. Interdependence between the two countries is still massive. Neither can afford what would be mutual assured economic destruction. If China goes in, China still needs chips out of Taiwan. If they go in and blow TSMC, they're hurting themselves much worse than anybody else in the world. So for lots of reasons, that's just not on. And that is one of our red herrings this year, by the way.
Okay, good. Glad we identified it. Cliff, thanks very much for joining us. Eurasia Group Chairman Cliff Kupchan. And of course, next hour, you'll get more details coming up in the next hour. We'll reveal Eurasia's top risks with Eurasia Group founder and President Ian Bremmer. That conversation at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is ahead this week. Today begins a new era of divided government in the U.S. as Congress opens its new session with a Republican-controlled House. But questions remain about whether House Republican leader Kevin McCarthy will garner enough support to become House Speaker. Then later on today, Sam Bankman-Fried is expected to appear in a Manhattan federal court. Of course, fraud charges, what he is facing among others. Then on Wednesday, we get the FOMC meeting minutes for December at 2 p.m., expecting to see policymakers concerned that the labor market is not cooling fast enough. And we'll be getting plenty of labor market data this week. JOLTS jobs openings are released on Wednesday, with initial jobless claims following that on Thursday. And Friday is Jobs Day in the U.S. The focus of the December jobs report will be on average hourly earnings, which could play a disproportionately large role in the next Fed decision. So basically, to sum it up, Matt, it's all going to be about the labor market, at least in the beginning of 2023, after it was about inflation in 2022.
Yeah, absolutely. And right now, 3.7% is where unemployment stands. And the question is, will the Fed, with its tightening cycle, be able to raise the unemployment rate, raise the so-called NAIRU to a level that's no longer inflationary? Is the Phillips curve real, and will it be used? Anna?
Yeah, absolutely. A lot riding on the data then that we get this week, and similar data in the months ahead on the jobs side. And interesting to see how those expectations around Fed rate cuts then, Kailey, evolve as we start 2023, because right now the market is expecting that we will pivot towards some cuts by the end of this year. But I speak to a lot of guests who say actually they're not sure that's going to happen.
Yeah, I think that is going to be one of the pivotal questions, considering the consensus call for risk assets this year seems to be it's going to get worse in this first half, then get better in the second half. But how much of that is predicated on some kind of policy pivot from the Federal Reserve, and what happens if that doesn't materialize?
Yeah, all those worries, though, for another day, perhaps. Risk assets rising, U.S. futures rising, European stocks rising early in January. That is it for Early Edition. Surveillance is ahead. They'll be hearing from Ian Bremmer of Eurasia Group, taking you through the key risks for this year ahead. This is Bloomberg.